Okay, guys, so we have an idea here for trading the US dollar index and Euro USD, which do trade in tight correlation because the Euro makes up such a large proportion of the US dollar index. Now, remember, the dollar index to start off with is the dollar versus six currencies, and this is the US's six biggest trading partners, and each currency has a weighting to make up 100% of the index. So we can see here that the Euro makes up nearly 60% of the index, followed by Japan, the United Kingdom, Canada, Sweden, and Switzerland. So why this is so important to understand is because the Euro makes up 60% of the index. We have a situation now where you can clearly see the correlation between the Euro USD exchange rate and the US dollar index. So if we see, for an example, the Euro USD pushing higher from around the 25th of September, that means the Euro is getting stronger against the US dollar. We then see around the same time the US dollar index going to the downside, because remember, the Euro is making up 60% of this index. So when we see the Euro going up in value on the 2nd of November against the US dollar quite strongly, we see exactly the same situation in the US dollar index. So the US dollar index is really just showing us the dollar's performance versus the rest of the world. How much is the dollar in demand versus the rest of the world? And at the moment, we're seeing a big decrease in the US dollar's value and across many exchange rates. And it's because lower interest rates in the United States since the pandemic took hold in the US in early March. Interest rates have been slapped to zero, and that means that the US no longer has that high yielding advantage over other currencies. So investors don't buy the US dollar no longer to earn a positive interest carry overnight when holding the dollar. So that's really depreciated the dollar's demand in the markets. And fundamentally, the US has a negative current account balance. So this means that more dollars go into the rest of the world to pay for imports than dollars come into the United States to pay for their exports. So there's always a surplus of US dollars going to the rest of the world compared to other currencies. And when you compare one currency's rest of world reserves against another currency's rest of world reserves, that's what actually creates the exchange rate as a ratio. So if the US continues to pump more dollars into the rest of the world, which is expected to continue because there's a huge stimulus package coming by Joe Biden's presidency in early January, that's in around $2 trillion. A lot of that will find its way abroad, and that gives a fundamental approach to a weaker dollar across the market. So we've seen how closely correlated the US dollar index and the Euro USD is, and now we're seeing the Euro USD come up to the key resistance level of 120. So you can clearly see, if we punch out to a monthly chart, 120 has been a resistance level before, a key support before, get rid of this, a key support before, again, support level, resistance. So going back to 1999, this is a big level in the markets. Now, why is this a big level? Probably to do with trade. The European Central Bank doesn't like the euro getting too strong against the dollar because it makes their exports more expensive for US consumers. So this could be a psychological level where the central bank could intervene and try to weaken the currency. But the dollar is expected to get weaker in 2020 for the fundamental reasons I did outline already. So if the euro does punch above 120 and we have a significant breakthrough, this could be the opportunity to buy Euro USD in the markets. And historically, the Euro USD exchange rate fluctuates on average on a 1 month basis by around 3.2%. So if we take the measurement for how many pips that is, if we take a buy position just outside of the resistance level and we put a 3% stop loss, we're giving the market the room it needs to fluctuate on a monthly basis on average. And you can clearly see the pullbacks are literally around 3% in the market. So when you give yourself this room for a stop loss, you're stopping yourself from getting stopped out early in the trade. So we can wait for a firm break and we can enter a long position for Euro USD. And just understanding how much of the dollar index makes up, how much of the dollar index the euro makes up, then we can also see that the US dollar is likely to break past its key support level 92. And if you go to the monthly chart, we can see 92 was a support level before, a resistance, a support, clearly going back to 1998. So clearly this is a key level again. And again, as we've clearly seen here from the examples I gave earlier, how much the euro was going higher than the US dollar was going lower. If the euro does break above that 120 level significantly, then the dollar index is going to pull to the downside. And what we can do then is we can take a short sell position in the dollar index, just understanding that the euro going higher is automatically going to push the dollar index lower. That's a fantastic trade we can take at the moment in the markets. And this will be a really good opportunity for us to get in and try to profit from this trade. So that's just giving you an understanding of the Euro USD exchange rate. Really important to understand and this could work out to be a really good trade for us in the market. So hope that makes sense. Let's see how this plays out. Thank you.